This is the Traders Exclusive Live Trader Showcase. I'm Sherry. This is the quarterly event where we feature expert traders and bring you training and insights from 20 expert traders. We have prize giveaways for everyone in attendance. We're going to do some drawings. We have some surprise interviews. Please check out tradersexclusive.com, where we regularly post articles and video clips with valuable trading tips and techniques. This is also where you're going to find the recordings for this event. And before we get started, we have to share a quick disclaimer. You know it. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. Past performance is not necessarily indicative of future results. This is training. You have to do your own research, and you should always verify and research. Larry Gaines of Power Cycle Trading. He's going to talk about how to trade extreme market uncertainty, low risk, high return option strategies, butterflies and condors. That's a lot too, right? But Larry, thanks for joining us. If you want to go ahead and unmute yourself, I'll turn you into a panelist, turn you into a presenter in just a second. Let me just say, I've got a little bio here. I'm sure I got a question for you before you get started. So what I have though is that Larry Gaines has traded professionally for over 3 decades and ran the international trading desk for one of the largest oil trading companies in the world while serving as executive vice president. Mr. Gaines founded PowerCycleTrading.com in 2010 and has taught thousands of traders his directional option trading process. He provides top quality trading education based on his proven proprietary directional trading model and option strategies designed to provide high returns on low defined risk. Wow. So what I wanted to ask you, Larry, was how did you get started in trading with the oil companies?
Good question. Well, I was fortunate enough when I got out of college, I spent a few years kind of looking around for something that I really wanted to do, and I was lucky enough to get my foot in the door at a company called Coastal Corporation in Houston, and they were a large refining company with trading, and we had refinings. All right, can everybody see that? That looks good.
Yes.
And anyway, so I got a job. I was able to get my foot in the door, got a job there, and they actually had a training program where they would train you how to trade oil at the time. So sent me down, they had a number of different refineries, but sent me down to their refinery in Corpus, Texas. Spent about 3 months down there just kind of learning refining, how a barrel of oil goes in, how it comes out, products. And that kind of started my career off, with Coastal, and then it ended up, spent about 5 years there, went out to Singapore for a couple of years, traded products, and then got a job at a company called Transworld Oil, which they were the largest oil trading company in the world, with Fibra and Mark Rich, and spent 17 years there, ran the trading desk for 10. So that's basically, long story short, how I got, got my chance, but never looked back. It was a great chance. I love trading, love options. So, it's been a pleasure being in the industry, always constantly learning. I call it a journey, trading journey.
Thank you very much. That is awesome. There is going to be a replay of this, of all of these sessions. So I'd just like to ask that question. Hopefully it's a little different than what you're usually asked. And I'll go ahead and mute myself and you take it away.
Okay, well, thank you so much for having me here, and appreciate everybody being here. So yeah, I want to go into how to trade extreme market uncertainty, and we're definitely been in a lot of market uncertainty here over the last year or so or more. So these are strategies that I like to use, butterflies and long condors. They're really low risk but high return strategies, great for any trading or investing portfolio. So again, like I said, I've been trading for over 30 years, and I found the most valuable go-to option strategies that can really literally help any trader or investor than any other trading strategies out there known, especially during times of extreme market uncertainty and volatility, really come down to what I call the butterfly and the long condor. So kind of what I call my trading secret weapon. So we'll go into why that is the case. So, the huge advantage that these strategies have is their unique option framework. That's really what makes them special. So they're is kind of designed to take advantage of both time decay and volatility, which are the two main option pricing components. And this really helps to stack the trading odds in your favor, and they can be used in any kind of market environment. So, which makes them a real favorite trading strategy to fall back onto when we're in uncertain times like we are now. So if you just know when and how to use them, they're going to be your best, one of your favorite strategies to incorporate. Now, because they're structured to require only a small amount of your hard-earned capital, your trading returns can be very explosive. My first boss at Coastal, he used to get real excited when we'd have a great trade. He'd say, this is like lightning in a bottle. So, you want to kind of bottle it up and do it every time. But that's one thing you can do with options. You can really make an explosive trade on low risk, but great leverage to give you those, big, explosive, fast returns. Now, when we look at the butterfly and long condors, they're also very dynamic, and they can be traded for a variety of different reasons with different goals in mind. So in other words, if you learn how to trade a butterfly or a long condor, you're going to be covered for your offense and your defense, so the goals and protection of your trading or investing. So it really give you a great combination in that regard. Now, they can be used no matter what the markets are doing. We can use it in an up, down, or sideways market environment. Can provide you income from stocks that are going nowhere. Really helps eliminate the stress of having to be perfect on a stock's direction or overall market. Eliminates the time decay expense that's encountered from decaying long options. Also takes the unsettling guesswork out of your trading. So that's a really big plus. It can be structured at a very low cost or low capital at risk, which is what I really like, and especially in these kind of markets. So you can literally get the returns, a positive risk ratio kind of returns of 10 to 1. So, basically risk $1 and sometimes make 10 or more dollars using a butterfly. Now, when we look at butterflies and long condors, they can also be used as hedging. So, you're going to have trades that go against you. So what I've found is literally these are the two best strategies that you can really do a fast, low cost way to cover your pronto when a position starts to go against you. And I found no other hedging strategy that really compares or come close. So they're real easy to set up, and they're fast to implement or execute, which makes them great for, if you get into trouble, you can quickly set up a hedge using the butterfly or long condor. So by constructing the butterfly or the long condor spread around a strike that is under pressure from another core trade, such as a credit spread or a debit spread, really becomes the best way I've found to immediately not only neutralize your risk, but also will lower that risk. And so this is, a hedging strategy that's really helped. Here's one of my clients, she said, Pam, she said, I wish I'd known how to do this hedging before I lost so much money doing credit spreads. So we can easily hedge a credit spread that starts to go against us by just adjusting it to a butterfly. And so I'll show you kind of how that works here as we go. Now, when we look at a butterfly, they're pretty simplistic. They're just a combination of vertical spreads. So you have you can do with calls or puts. So for example, this would be like a call debit spread, your long call, short a call. And right here, you went long that call, that's say 10-10. And then you shorted a call against it that caps your upside, but reduce your cost or your risk. And so you did that at 10-20. So it's $10 wide spread or $1,000 wide per option contract. And with this, your debit cost is $300. So your potential profit is the difference there of $700. So nice risk reward. But if you wanted to reduce this risk, we could do it really quickly by adding a credit spread that could convert it to a butterfly like that. So what we could do here in this example, we could go out and we could sell a bear call credit spread, sharing the same strike or short strike as that debit spread. So here we would have this credit spread that we could add to it. And now we're short a call, long a call, same spread, the 10-20, 10-30, so $10 wide. In this example, then we bring in $200. So that's our credit received, and the risk is the difference of $800. So when we look at credit spreads, they're what we call a negative risk ratio type trade. So in this example, you're risking $800 to make $200, right? So $200, so that's a negative risk ratio. And so most people would say, okay, why in the heck would I ever do that? But these are what we call probability trades. But by executing a credit spread with a vertical credit spread with the debit spread, then we can convert, you can convert butterflies. We can make these long condors that look like this. We can do all sorts of really creative things using those spreads to reduce risk and also to reduce data. Now, once we've done that, then you've got a structure that looks like this, and this is a balanced looking butterfly. We can have different variations of butterflies as well. So from this example, we started out with a $300 debit cost, reduced that risk by selling the credit spread against it. So now we've got a maximum risk of $100. So if we're totally wrong, $100, your max loss, and your profit potential is the max if it goes out here. This is what we call the top of the tent. But you have a big, good profit zone all through here. But we'll reduce that credit or that risk down to 100, and we've got a potential in this example to make $900 on that risk of 100 or 900% return. So that you can see why that could be a great advantage to you when you're trading any market, but especially a crazy uncertain market environment like now. Now, a kind of variation off this is what we call the long condor, not to be confused with an iron condor. So all this is doing is widening the zone of profit zone here. So the basic concept here is the long condor is also going to be long. You can do calls or puts, so long a call, short a call, so debit call, debit spread. And then instead of doing a short strike right at the same strike as your debit cost or spread, you widen it out. So it gives you a wider profit zone. So you can see it's a combination of a debit spread with a credit spread versus the iron condor, which looks similar, is a credit spread, two credit spreads. So it'd be like long, a short a call credit spread and short a full put credit spread. So it's a big difference with your payout. It's going to be huge. And I'll show you some good examples so you can get a better idea. So the core concept that makes these work, let's go through the kind of basics that really make them dynamic. So when we look at the most important option factor, for this kind of profit generation using either a butterfly or long condor, it really comes down to understanding how option pricing works and then the concept of that time decay or theta and the effect that it has on an option price. So let's kind of look at that core concept and take a quick review of that, and then we'll move forward. Now, when we look at that concept, it comes down to time decay or theta, and that's the Greek that tells us how much an option price is going to go down over time. And that's the rate of your time decay or of your stock option. And this time decay occurs because that extrinsic value or that time value will go down as we get closer and closer to expiration and finally go to zero. So it's a kind of decaying asset that we can take advantage of by adding this to, as a vertical spread to create either a butterfly or a condor. So we get that big advantage. So here's kind of a, kind of simplistic example, but kind of illustrates the point. So here's like XYZ and it's trading at $45 and we're looking for just a small move to 43. So with the butterfly, we can do, wide butterflies, narrow, we can really shape our risk based on the spread width of the spread of the butterfly. So in this example, we're looking for a move to 43. So I like to call that my target. So we're going to target that 43. So I kind of like to do butterflies with a kind of target in mind. So in this example, we're going to be then long the 44 put, targeting that 43. So we're long the 44, long that a debit cost, and then short the 43, and then we're going to short that 43 again and buy the 42. So we've then created this narrow butterfly. So it's a fixed debit cost trade with the amount of potential profit up at the top of the 10 or anywhere in between. But we've reduced that risk. We can really shape it to very, very minimal. Plus, we always get a positive theta. So in this example, you can see your debit cost was $238 for that 44 put, $1.06 for the 42, and then you brought in the $1.67 twice from selling that 43, converting that to an option spread. That's $10 per option contract or spread. And then your profit, just take that middle strike less your lower strike or whatever. You can see it's a dollar wide spread. So you've got 43 minus 42 less the cost of the trade of 10 cents or $10, and that gives you your potential profit of 90 cents or $90 per option spread or butterfly spread. So that's a return of 9 to 1. So you're risking $1 to make $9, which is that fantastic leverage on very low capital at risk. So you can see the big advantage of that for any market, but especially when you're in times of uncertainty, you can really keep those costs of the capital, your risk down pretty small. Now, the next thing comes into how do you choose the best butterfly or long condor strategy, to match your trading goals. So, everybody here is going to have a different amount of trading capital, different times to trade, are you, full time or are you just kind of more passive? But one major goal, in my opinion, of all traders should be to select trades that are going to be based on what's going to give you the most consistent positive returns over time with low defined risk and not always that greatest return. So I always tell my, members and clients, I like to look at the risk first and then back into potential profit to look at the risk reward. But I like to look at it, the risk first, and then, we're going to hit singles and doubles, and occasionally you hit the big home run. So that's the way you really stay consistent in your trading, to live another day. Now, one of the best ways then to do this is by being aware of the different option strategies that are out there and available to you, then understand how they work, and then select the one that's going to be best suited for the market environment you're trading or your specific trading goals. So, these butterflies can be done for hedge funds. I've seen, $25,000 spreads done, or 1 or 2 spreads. So you can do it with a small account or a large account. It doesn't matter, but that's the great thing. We can slip in and out of these things as a smaller trader. So I kind of call it sometimes a stealth trade. So really great advantages to these two types of strategies. So let's go into a little bit more depth about the variations. So when we look at the butterfly strategy, there are a number of different variations that kind of call it the butterfly family. So we have what we call a long call or put butterfly. Then we have what we call a broken wing call or put butterfly. We've got what I kind of refer to as the mean to unbalanced or ratio butterfly. We've got an iron butterfly, and then we've got hedging, great for hedging. So for any defending a trade, they're a great way to incorporate these into your hedging strategies using either butterfly or long condor. And then we've got kind of what I call the cousin, the long condor, where it spreads out that profit zone. So these variations can be used in multiple different situations and really give you a lot of flexibility, in your trading as you're going forward. So I thought next we could look at a kind of a review to go over, a bunch of different trades that we've done to kind of show you how they work, to give you a better feel. And then this will be easier for you to kind of recognize maybe which ones you'd like to use in your trading. So first thing we'll look at the butterflies, and the way to adjust your risk is through your wingspan of the butterfly. So, if you're, a collector of butterflies, literally, you could collect butterflies a lot easier if you used a big net, big wide net versus a small butterfly net. So the same kind of situation with the butterfly. So we can get a bigger profit zone by widening that butterfly spread. Or if we want to tighten up our risk, then we can make it very narrow, but have a big return on that lowered capital at risk. So it really provides you these kind of really great advantages for your trading. So the first one we'll look at is butterfly. I'll go through a bunch of different examples. Be happy to take any questions that you might have as well. So here's what I call kind of a lotto trade. So this is a really narrow wing butterfly, and this was on the S&P 500, SPY, the ETF. So they're great for ETFs like SPY, the Russell 2000, IWM, QQQ, the Diamond, et cetera, and great for stocks. So, with the different strikes and expiration dates, they're really great for ETFs. But here's an example of one that's a narrow wing butterfly to make the risk super, super low. And, when I'm looking at trade setups, I always look at the direction first. And then when I look at the chart pattern, the direction, then I kind of incorporate, okay, what's the best option strategy? So in this example, I also like to use Fibonacci to give me profit targets to trade against. So this one, just taking a kind of swing high to low, gives Fibonacci levels. So 382, 50% retracement, and then the 618. 618 is a really important fib level. And on this trade, this was a SPY, it was trading at 267. So it's trading right about here. And there was this target right here, that about 273, 274. There's also a lot of option activity going on right there. So it gave us a really good profit target to trade to, that 273 strike. So a target there to set up a butterfly targeting 273. So with this trade, what we did was go out and we bought, it was trading at 267. So we were targeting the upside at 273. So bought a 272 call, sold the 273 dollar wide spread, then sold the 273, bought the 274. So a very narrow dollar wide spread. And this was done for 10 cents or $10 per option contract. Now your potential profit is your spread width of that $1 or 100 less the $10 that you put up for capital risk. And you can see here, theoretically, if it hits that top of that 10 perfectly, which it never does exactly, you would make $90, which is a 900% return. So in this example, we had two contracts on, I believe, and made $70 per spread, so 700% return. So, if you're telling your friends or whatever, hey, I just made a 700% return, they'd probably say, think you're lying. But with the butterfly, you can literally do this, 700, sometimes even greater than that. So here's what it looked like as far as the profile of it going out. So you can see here it was set up when it was trading at the 267, targeting that 273. So it came really close, 273.08. And so you can see this went from that 10 cents or $10 debit cost up to 80 cents or $80. And there's your profit of $70 per spread or 700% return, $70 on that risk of 10. So that's, giving you that great advantage of your time decay, takes advantage of volatility collapse and your, really high return on capital. So we've got that sell side by selling the credit spread part of it, which sells time and volatility. And then we've got the debit spread side that can give you the greater levered returns for the trade versus just doing a credit spread. Now here's some more examples. These are kind of wide wing butterflies. And so typically I like to look at the wider wing butterflies because that's going to give us a wider profit zone. And that's going to be structured for defined risk and hedging, used for targeted directional swing trades, used for directional pinning trades, used for trading high volatility markets like we're currently in, and for trading high price stocks. So trade duration typically could be 1 day to 2 weeks. Kind of I like to go out, literally we'll do these 1, maybe 2, 3 days out to expiration, or maybe a week out. The sweet spot is about, maybe a week out, something like that. But you could go further out in time, but you just have to wait based on this construction. You have to wait a little longer, to optimize that profit due to, the theta decay that, kicks in closer to expiration. Now, these will always give you a positive theta, which is great, no time decay. And again, you can get returns of 2 to 1, 10 to 1, sometimes even higher than that. So here's an example of one that we had set up on SPY. And this one was a wide wing butterfly, a put butterfly looking for a downside move. So we set this up with a spread width of $700 on the spread. So I've got alert service, and a lot of these trades are trades that we did through the alert service. So this will show you kind of how this trade went out, what it looked like. So in summary, it was trading right here at $378 basically. And we were looking for a move down to a certain target. And so we were able to set this up with a low capital at risk of $115 per spread, with the potential to make this thing, if you hit it perfectly, would have made 585 or 508% return. So you can see here, this was the summary of the trade. It says go long that 26 September, the 377 put, short to the 363, and then that should be the 357 or so. That is wrong there, but that's the alert, what they look like going out. So here's how the spread worked out. We'll go through the construction of it right now. So this was the risk profile. You can see exactly what it was looking like. So we did it was trading at here about 379. We were looking for a target down to 370. So that was kind of our target. So we put the short body of the butterfly right there at 370. And so we did this $7 wide. So we bought the 377 put, sold the 370, bought the 370 again, sold the 363. So that was your kind of wider wing butterfly, $700 spread width. less your cost of the trade, 115, so $1.15 or $115 per spread. So theoretical profit, if it hit it perfect right here at the top, would be 585%. So we can back into our risk reward. So not bad. So potential to make over 500% or risk $1 to make over $5. So you can see here the potential 585 profit on your risk of 115. So really great low risk trade, but really potential for a big payoff. If you get that direction to kick in your favor. So here's where it went out. You can see here's the trade setup. This is actually wealth charts if you are familiar. So I use wealth charts, I use Thinkorswim, but these are my trading indicators. So this was a short strike right there. We were selling it short here. It was basically trading at that 369 area. So my momentum indicators were giving me direction to the downside. So that's where we were, set the short, and then we were targeting down this, area here, that 360 or 360 area right there. So we set the butterfly up based on that. Let me get rid of this scrolling tool here. All right, so what we ended up was, it was 370 was our target. So what we ended up doing was this long the 377 put and short the 370, and then short that 370 and long the 363. So that was the structure, and set this up, was trading up there at 379 basically, and we were targeting that 370. So got down here to that 370 area, and when you're taking these things off, what we'll typically do is we'll kind of scale out, because when you get to the last day of expiration, we have what we call gamma risk. So they can kind of go all over the place. But typically, we'll take some off and then try to hold some right into the last expiration day. And you can see here, this area here, that black area is what's left of potential profit. So we were taking it off right here. So at that point, it was trading at 369, very close to that short strike that we were targeting, 370. And this was up $240 per spread. So over 200% return in 5 days. So that's the beauty of it. And, it's a trade that's low risk, and then we can scale in, scale out, or we can, leg in, leg out. So we could start off with a, in this market where it's breaking down hard, we could start off with a put debit spread, and then if we wanted to, add the credit spread to create the butterfly. So it gives you a lot of different things and options and flexibility that you can do with your trade once you understand, how to combine these verticals. Now here's one that we did just recently. This was on what we call a penny trade. So we were actually looking at a monthly expiration, looking for a certain strike price for where some security to go out. And this was on Google, and we were looking for Google to go out at about $100. This was last week, so I wanted to show you how this worked. So Google, when we set this up, it was trading right here at trading 95.75. So right about in here. Right about here. So the system model that I use gave us a buy signal right here. Okay, momentum going up, cycle reversal, etc. And then we were targeting up here to this 100 strike right here. There was a lot of option activity there, and then you can see there was that big 200-day moving average above it. So it looked like it'd probably be capped here. A lot of option activity at the 100. So that was our target based on that, and based on potentially going out for a pin. So we set this up, doing this a $4 wide spread and targeting that 100 strike. So bought the 96 call, sold the 100 call, sold it again, bought the 104. So we had this $4 wide butterfly, cost of the trade 80 cents or $80. So the spread width of 400 less 80. So theoretically, potentially you can make $320 right here on your risk of 80. So 400% return on that. But you have this, profit zone in here that you can take advantage of. And, you don't have to nail it perfectly to make a really great return on your capital that you're putting up. So let's take a look at where this thing went out. And it overshot a little bit here. So it went out and overshot to 101. But even with it at 101, not perfectly at 100, this made a really nice profit. This was up over $200. So you can see it was trading at 101.12. And at that time, it was at $205. So bought it at 80, went up to 285, profit of 205 or 256% return in that three-day period there for Google. So, excellent little, trade setup there, and again, very low risk. Now, here's a really good example of how you can incorporate this for trading really high-priced stocks, and lower that risk using this kind of really wide butterfly. So this one was actually $10 wide or $1,000. Now, this example I like to show it because this is back when Amazon was trading at $1,700-$1,800 per share. So it was really most traders couldn't afford to trade stock because it's just so high priced. But we could do this with the butterfly. So here's an example, just kind of illustrate how this is something you can use. So Amazon have been trading, really flat right here at support. That's like a 200-day moving average. And we're looking for just a kind of a measure move up here to 1830. That was kind of our target we were looking for. So, it was trading at the time at 1,782. So, relating this to if you bought 100 shares of stock, you'd have to pay over 178,000. So that's a lot of risk, right? So, directional risk of 178,000, even if you're not going to lose the whole 178, but this thing, if it went back down, you could lose a lot very fast. So we were targeting 1830. So we were able to do this spread for $80 versus $178,000. Okay, so that's what's amazing, an eye opener. So here again, targeting that 1830. So went out and bought the 1820 call, sold the 1830. So $10 wide there. Sold the 1830 again, bought the 1840. So we had this wide wing butterfly like that. So $10 or $1,000, and the cost of the trade was 80 cents. Debit costs are $80. So potential to make $920. That's 1,150% return if this thing was nailed perfectly. So 920 on your risk of 80. So you can see the beauty of it for helping you to trade high price stocks or even high volatility stocks. Now here's another really great example of the other benefit. And that's where, you go out at expiration, and what happens with option pricing, time goes to zero and volatility goes to zero. So in this example, it illustrates that. So here's the spread. This was on expiration day on the 6th, and this was in the morning about 9:30 or 10 a.m. So at that time, it was trading at 1836.55. So it was right here, that purple right there. But even trading right there, so you have a huge potential still profit in that, all that black area. That's what's left of time and volatility. So with the cost of 80 cents, now this thing was trading up to 230 or $230. So you've got a return right there at this point in the morning of $150. So still a really nice return of 187%. But the same trade in the afternoon, you've got all this potential profit still sitting there from the time and volatility still in the option spread, which will be sucked out as it gets closer to that end of the day expiration on that Friday. So here it is just a few hours later, and now it's going to be up 400 times or 4x what it was in the morning. So here it is the same day on the 6th, and this is late in the afternoon, about 2:30, about 30 minutes before the expiration, and now it's trading still about close to the same price 1832, but it's gone now from $80. Now it's trading up to $695. So you can see earlier it was $157 profit. Now it's $614 per spread profit, or 769% return versus earlier that 157%. So that's the other really great advantage that you get to incorporate taking advantage of that theta decay that goes to zero and volatility at expiration. So just kind of wanted to point that out as another really special benefit that you get from using, the butterfly. Now then, here's what I call kind of the cousin of it, so the long condor. And this was one that we set up with the Russell 2000 IWM, doing a call debit spread. And then what we did was adjusted this to a broken wing long condor. So we have, like the butterfly, we have the different variations. We can break a wing and do wider wing up or down, and kind of really structure the spread width for controlling our risk. So this was an example, another alert trade set up for a long a debit spread, then adjusted to a long condor. So the original trade was set up here buying a vertical debit spread, buying the 177, 179 call debit spread at 95 bucks. And then what we did was we made an adjustment on this. So it was trading at 55 when the cost of the trade when we adjusted was 55. Now we made the adjustment, it was right here. Let's see if I can point this out. So what we did was we adjusted it here, and down here, let me find the summary. We adjusted this to a long call condor right here. So it ended up being long the 177 call, short the 179 call, and then we sold another credit spread against the 186, 189. So we had this call debit spread that looked like that to start off, and then when it moved up, we widened out that vertical credit spread out like that, and then created a condor, a long condor. So we were long the call debit spread, and then when it moved up, we were able to sell further out of the money credit spread, reducing our cost of capital, also increasing our theta, and enhancing the trade to more profitable trade, based on the capital that we're at risk, which we lowered. So let's go through the details of how this one worked out. So going through this one, here's the trade setup. Again, using the indicators I'm showing you, this is Thinkorswim. And we had this trend line breakout, moving averages being broken right here. So momentum indicators were pointing for an upside move. So we went long right in here. It was trading right about 177. So went long right there. And then it broke to the upside, and we adjusted this to reduce that cost on the debit spread side and locked in more profit and also reduced theta. So we adjusted here and then took it off the balance right there. So let's go through how this one worked out. So this was adjusted to what we call a broken wing call condor. So now it was trading at 182.15, and then on the 12th we took profit. It was 182.28. So here's what the spread kind of structure looked like. So we were originally long the 177, 179 call debit spread, and then when it shot up, we sold the 186, 189 against it. So this is creating this condor, and this is right here, $2 wide spread, so $200 less your cost of the trade. We knocked down the cost of the trade here to $68. Okay, so the potential then is to make $132 per spread. That would be 194% return. So we've lowered the capital at risk, and we've also then increased our positive theta. So that's what I'm always looking to do. Either can I reduce the capital I'm putting at risk, make the trade better that way, and can I increase my theta to make it more positive so I don't get theta decay? So you can see here on the profile going out, so it was trading right here. The adjustment was done on the 11th, made it into a broken wing, so it looks like that. So broken wing down like this. So we had the trade set up a total cost of 68. And then we had the going out between the two short strikes right here. So this was on the 12th, and this was up $182. It was trading, I'm sorry, it was trading at 169. So it had a profit of 101, and that was 149% return at that point in time. And then let's see, I think I've got the next chart here. Yeah, that was it. So it went out there, trade right there. So we went ahead and booked that profit. So a really nice way to trade. But the thing is, again, take a look. I look at the risk first, $68 of risk. So you can see the benefit from that. It's to lower that capital risk, and you can make these fantastic levered returns. And your defined risk, so you're risking that debit cost that you put up. And we can leg in, we can leg out. Now here's another one. This is a really interesting one for you. This is one that we did on XRT. And so this was one we started out with what we call a long put calendar spread. It's another favorite. My favorite option strategies are the butterfly long condor and the calendars and calendar diagonals. But I like debits. I like all of them, but these are some of my favorites. And so what we did with the XRT was we had a really super low risk put calendar. And again, I call it a target trade. And then the whole basis of the trade was we were looking to see, okay, if we had our move to where we wanted to go, we were going to look to see, could we adjust this to a free trade? So when you're trading, especially options, think 2 or 3 steps ahead. Don't just think one outcome. Think, how can I enhance the trade? So can I make the trade, more potential capital, lower my capital at risk, increase my return, and can I increase my positive data? So that's what I'll always look at. So this one we were able to adjust to a free trade, so no risk at all. So the trade was initially set up here. You can see it was buying a calendar. So this was a alert trade. So buying the 66.10 March, selling the 24 March 66, and then we did the adjustment on the 28th. So what we did here, just a quick through, we bought to close the calendar, the short strike calendar that was closer in, took a profit on that, and then sold to open the same series as the long dated, the 10 March, sold the 65, and then we sold a 64.63 bull put credit spread, creating a calendar. So we start a condor. So we started out with this calendar that looks like a kind of a credit spread almost, and then we closed out the short strikes of the short duration trade and adjusted this to a long put condor with 0 risk. So I'll kind of walk you through this one. So these are what I'm always looking for to try to think through, okay, how can we make the trade better? So here was the initial trade set up, trading right here at 67.74. The initial trade was set for a calendar targeting the 66, just a small move down. So we can do this for very low risk. And then we had made an adjustment on the 28th. Once it moved down here, right here, we were able to adjust this to that put condor debit spread, and then took it off there. So let's walk through this. This is a pretty cool trade. Let me get my pointer here cleaned up, and let me take off the drawing tool. And okay, so the initial trade looked like this, a put calendar. And this one, what we'll typically do is take profit on part of the trade and then adjust the balance. So this one actually worked out great as a calendar. So you can see our risk on this trade going in was $99 for doing a calendar. So this was set up targeting 66 on the calendar. Now, the calendar made a profit of 44. We were up 44. So what we do is we book some profit there. And then, if it sets up, then we do adjustment if we can do the adjustment. In this case, we did it to a free trade on the 28th. So we adjusted it to a long put condor free trade. So basically meaning there's no risk in the trade. So let's go through and I'll show you how this works. So basically we had here the calendar, and then on the 28th made the adjustment. So what we ended up with was then we with the initial calendar, we were long this 10 March 66 put, and then with the calendar where we started off, we were short a shorter duration strikes against it, closed those out, and then went short the 65 put. Okay, so we had that put debit spread like that. Okay, so we're long the 66 put, then short the 65, and then it dropped down pretty hard. We were able to then sell a bull put credit spread here, the 64.63, bringing in $17 credit. So you can see here the adjusted price that we had on our 66 put from closing out the short duration trades that we had on the original calendar. We adjusted the price down to 70 from 99. And then when it moved down hard, we were able to sell the 65 put at 70. So that covers that debit cost there. And then we sold a credit spread for $17 credit. So now we had a 0 risk trade. We actually had a credit. So if it went up, went down, we still make $17. And then you can just sit back and let it work its way. So here you can see potential to make that $117 on that credit of 17. So here's the structure: the 66 put long, short the 65, short the 64, long the 63. So that's what we call a put long condor. And so this one worked out, the way we wanted it to, which they're not all of them do, but a lot of them do. So it's amazing. We have pretty good success rate. But this XRT, then we ended up right here. You can see where it went out on the 9th, and that was the day before expiration on the 10th. And so it was trading right here, right there, and went from you had it on at $17 credit. Now it was trading, that spread was at 52. So the spread was up $69 per spread. on zero risk. So those are a really cool little trade setup to incorporate into your trading plan. And so that's XRT. So basically, if you'd like to learn more on how to master these high reward, low risk strategies, and again, that can work in any environment, but really great when we get in kind of market environments like we're currently in now. And let's go through, I've got a really special offer for everybody here today. And let me think, I think you've got my link here. If you can add that into the people. So
I'll put it right there.
Thank you. So this is a super good offer for you. This is you're going to get 6 bonuses plus this. When I did the Butterfly Long Condor, you're going to get this option master's course that I did. So very, very detailed course, 7+ hour course broken down in modules of 30 minutes or less. So it's easy for you to go back to certain chapters or modules to kind of review. And then not only will you get the course, but I'm giving you 6 other really great bonuses. Everything here for just $197. So it's yours forever. And so here's everything you'll get. So really good special offer. You'll get my recorded on-demand 7-hour course broken down in modules. Now, if you go to my website, powercycletrading.com, this course is $397. So, check it out, powercycletrading.com. You can see all my courses, all my trading indicators, but you can just verify that price there. Now, additional bonuses you're going to get for your trading library. If you're just starting out with options, this is what's great, because I'm going to give you this course that I did, Start Trading Options Today. So a relatively new course here, just a start trading options today. So it's going to, give you everything you need to know to kind of get familiar with the options, how they work, the pricing of options, how option expiration works, things like that. So on my website, this is $197. So, and then I'm going to give you a 30-day trial membership just for signing up. If you buy the course today, you're going to get a trial membership for 30 days. So you can come in my trading room, check out things that we're doing, ask any questions on any trades that you have. And you can start this whenever you want. You don't have to start this right away, but you'll get 30 days. If you then stay on, it's $97 a month, or you can do an annual membership. And then you're going to get a live follow-up Q&A. We'll send you a link for that, so you'll have that. And then you're going to get my bonus for how the pros use the Greeks. So this is another option guide going through the Greeks, theta, gamma, exactly how those work. And then you're going to get another option, what I call my manifesto, 15 other different option strategies, and my Greek power tool guide. So a really great combination of things for your trading library for options to really get you started. And let's go through all the different pluses that you're going to get. So you're going to get the 7-hour course, 30-minute modules. So this comes with the 456-page training manual, the entire course. So really kind of what I call my blueprint course on the Butterfly Condor, Long Condor. So using it for income, using it for these high reward, low risk trades, directional trades, hedging, and more. So you get all that. And then the course is broken down. I always like to start out with the Greeks to kind of go through how those work, and how they are used, for the Butterfly Long Condor, so you understand that. So really good training course for options in general. And I go through the theta decay, the impact that it has on your Butterfly Condor, volatility, the importance of that, how that works, what we call volatility crush. Then, understanding how option pricing works. That's a really key to understanding these option strategies. So go through that, spend some good time on that. And then another big thing that I go through in the course is what I call price target mapping, and that's using Fibonacci and standard deviation and some other things. But what this does is help to establish, profit targets to trade against, either up or down. So it's a way that we set up our targets. Okay, so this is in the course. I go through that in great detail, so you'll understand that. So a really cool part of the course right there. And then it doesn't stop there. So then we're going to go through part 2. Is we're going to go through every variation of a butterfly. So we're going to go through with trading examples of how, why, when would you use a long call or put butterfly, a wide wing butterfly, broken wing butterfly, ratio butterfly, broken wing ratio butterfly, iron butterfly, vacation butterfly, long condor. So it's like the Bubba Gump of shrimps with the butterfly, everything and all the different variations. So go through those real thorough with detailed examples so you can see those. And then what are the best option timeframes to use? How far out should you go on your butterflies? what are the best things to use. They're great for ETFs, great for index options. How do you get those structures where you get 10 or 1 or higher, with as little as $10? How do you get that profit from taking advantage of volatility, crush, or theta decay? And then we go through, pinning trades, kind of like that example I showed you on Google. And these are really fun as well. So, these are based on a monthly option expiration. So 12 times a year, you get some really great opportunities to do these kind of trades using butterflies. So what we call, pinning trades, target setups that we set up and establish, and then use typically a butterfly to trade it so we can get a really low risk trade capital on the trading. And then we go through the section of the long condor, so go through in great detail how this spread works that can also provide great returns. Not as great a returns, but it gives you a bigger profit zone. So it's a really, one that I really like. And so this is, typically you'll get either, 1-to-1 or 3-to-1 on your money on these. Also gives you a positive theta. So I'm going to go through in the course how, why, and when to use the long condor spread in your trading. So that's a really big part. And then part 3 is just dedicated totally to hedging. So what I call the progressions of hedging. So how you hedge a share, how you hedge a call or a put, and then how to use the butterfly and long condor hedge to hedge a core position that you maybe have on. Or the other great importance is using the butterfly or condor hedge to defend either vertical debit spreads or vertical credit spreads. So different ways to do that. So that's gone through in the course. And then a step-by-step checklist of when to put these things on, take them off. Execution, risk management, how option expiration works, assignment risk, auto exercise and assignment, and you get a trading library of other trades to show you. I really helps me to learn when I go back and look at structures of trades and see how they worked. So you get a good trading library for all that. So that's part 3. And just a little feedback. This is from a couple of my members that took it, said, Alicia, I've never seen anyone explain options like this. Excellent. This is exactly what I've been looking for. Very informative. No one has anything like it. Wish I had found this sooner, but I'm glad I found it now. Thank you. And this was from Pam, who did the credit spread, kind of comments earlier. Excellent class, Larry, as usual. Under promise, over deliver. Wish I'd known how to do this hedging before I lost so much money on credit spreads, Pam. So that's everything. And then just going through your bonus package. So you're going to get my start trading options today. Did this back in February, so very new. So option beginners course. So this goes through using the benefits of options versus stocks. How to use the options. The basic tips for that. Must know option basics. The difference between puts, calls, option expiration. And then I go through 2 different strategies. I go through the covered call and a covered call with the protective put. So a really good trading course here. If you're just starting out, this will really complement for you to move into the butterfly course next. So all this included for just that $197. And then you're going to get my cycle. You're going to get my membership, 30-day trial membership. Again, you can start this when you want. So your access to my virtual trading room every day, 9:30 to 10:30 in the morning. And then that's with me hosting, nobody else. I do a daily video newsletter update every day after the close. These are archived. Then I do a Q&A, usually every Tuesday, live and recorded. Traders Education Ball, and then anything on my website, all courses and software. I got a lot of software, trading tools, 6% discounts on all that. And then we'll do a live follow-up support Q&A, which will be live and recorded, so you'll be invited to that. And then it doesn't end there. Then you're going to get my how the pros use the Greeks. So this is a short course on just the Greeks, the delta, gamma, theta, how option pricing works, the market maker secret, standard deviation, option delta. So just another great course with videos to add to your your trading library to get you started trading options. And then a couple more little bonuses here just to make it even more enticing and nice to you is my 15 option strategy guide. So this goes through different strategies like the back ratio spread, what's long straddle strangle, short iron condors, long iron condors, credit spreads. So really nice addition to your library on this. And then the simple brief option reference guide you can print out, put on your desk on, what is gamma, what is theta, rho, things like that. So really a great combination of everything that can, help your trading in general, but especially get you up that trading ladder on options. So Again, thank you so much for having me here. And if there are any questions, I still have a little bit of time left.
Asi asked, where do you see the delta, or what is the probability to stay in the profit borders? And John also has a question, but I would like you to see that one from Asi.
So the delta, or just
He said, where do you see the delta? And this was at 4 o'clock.
Okay,
And
yeah.
4:01. Mm-hmm.
Yeah, sure. So yeah, if we're looking at delta, you use delta. That's one of the main things I look at. On every trade, I'll look at delta. Let me show you here. So we were looking, man, I was about to do a trade there on the Russell and then had to jump in here, so I missed it. But anyway, so if we're looking at, what do you want to see the delta on? Let's pull up maybe Google or something, and we can look at the deltas on Google. So, with this Thinkorswim, so I'll just put it here. The way I like to use it, I put it to what we call all of this little drop down. Here it is, implied volatility, probability out of the money, delta. Okay, so let's say, you're looking at the probabilities, and this is where you can get that information really fast. So if you're looking at, and I'll pull up a chart to guide you through it. So if we're looking at, let's say, Google, let me pull this chart up so you can get a kind of an idea of it, and then let me pull up this option chain. So let's say you wanted to trade Google, and you're looking at the probabilities of certain strikes being hit within a certain option series, right? So when we look at our option chain, we've got all these different option series, okay? So Google, we've got the 24 March, 2 days, so Friday expiration, then we've got next week, the week after. So if you want to go out and look at, okay, so let's say you think Google's going to go up here to 110, okay, just picking a number. So what you're going to do is look at the option delta to give you an idea of the theoretical probability of it actually making it to 110. So the first thing I will usually do is I'll look over here, and this will tell me what we call the expected move. So if we're looking, so let's say we want Google, we think it theoretically, we like it to 110, and it's trading here at 103. So that's $7 up, right? So $7 up. What I'll look here is look at the different series and look for at least something like this where it says, okay, here's $6 up. So that would be a normal, theoretically, we could look at this series here, the 6th April, 15 days out, and that has theoretical probability to get us up here $6 or $7. And then we break that down, we can look at the option delta. And so I'll just open up that series real quick right here. And here's the delta. So if I'm looking at the 110 strike here, right there, you can see the delta here is showing me a 15 delta. So one way to interpret that is, so we're looking at, okay, 110. Okay, what's the chance theoretically of getting there to 110? Well, if we look at the delta, it says 0.15, all right? So the way you can interpret that is that has a 15% chance from 103 over the next 15 days. It's got a 15% chance to get to 110. Or the reciprocal of that is 86, which is if you just take a delta, which is 100, less 15, then the difference is basically, 85. So the other way to look at it is there's an 85% probability that price will be below 110. So that's kind of the long and short of how to use delta.
I think that was exactly what they wanted to know.
Okay, good.
I'll cover. You have contributed a prize, and I would like very much to award that prize right now. So would you please write down a number between 1 and 500? And then everybody listening should write down, don't start yet until Larry tells me he's got his number.
Okay.
You got your number?
I do.
All right. Okay, Sammy, you can only do one number now. Are you going to do just the one? Okay, cool. All right, everybody, between 1 and Did I say 500? I did, didn't I? Okay, come on, everybody, put your numbers in there. I will tell you what it is that's up for grabs, because look at all the stuff that Larry's giving you for $197. My word. He's going to give you a 30-day access to his option trading room, which is pretty fine. So we need to, as soon as you guys are done putting your number in, then we're going to check with Larry and see what he picked. Woo! Almost everybody's in. Come on, anybody lagging back there? I'm going to wrap it up in 1 minute. Tick tock, tick tock, tick tock.
Drum roll.
All right, I think everybody, it's slowed down. I think everybody is there. So, Larry, reveal the number.
Are you ready?
Yes.
150.
All right, so 150. Let me just see. I'm scrolling. And if we don't have a 150, we'll take the one that's closest to it. Let's see. No, I see. You can't do that.
Hey. Oh, there.
All right, you know what? I think, let me just double check, but I think it's going to be CR with 124. Let me see if there's anybody closer to 150. I think 124 is the closest, so it's got to be CR. CR, I need you to send an email to support@tradersexclusive.com. I'm going to put the email in there. And what I'll do, there is, Larry, you did give me a link for them to go to, but I want to make sure that tradersexclusive.com. I want to make sure that I connect you both. So I want an email to me about this, and then I will CC you, and you guys can get, I'll give them the link, and then I'll get you guys together. How about that?
Okay, sounds great.
Thank you so much for contributing, and thank you for this amazing offer. You guys, I put the link in the chat. It's powercycletrading.com/trade1. And it doesn't matter if it's upper or lowercase. It's all lowercase when it comes down to it. So check that out. Now, you know you're going to get email from everybody, but you're going to want to check this out. So this is great. And look at this. KM says, Larry is a great mentor and has great course materials.
Oh, thank you so much,
go.
Kate. Yeah. Thank you so much. Appreciate that. Make sure to
Thanks
be in the
for
trade
being with
room.
us.
Hey,
I
thank you
really
so much,
appreciate it.
Gary. Huh?
I say I really appreciate you being with us.
Oh, thank you for having me. I really appreciate being here. So thanks, everybody. Gary, thank you, KM. Again, you guys and gals have a great rest of your day. Good luck trading tomorrow.